By your late 20s, you've probably already made at least one expensive money mistake. I made several, and the worst part wasn't losing the money, it was realizing how much time I wasted with it. I'm just a normal guy who quit a six-figure corporate job and moved to Taiwan. In this video, I'm breaking down exactly what I do with $10,000 if I could go back to my younger self, knowing what I know now. So let's get into it. Now, I'm going to break down the 10K across 5 different buckets. And the percentage allocations work at any number, so don't get too hung up on the dollar amount. First, I would put $1,000 or 10% of 10K on skills that directly increase what you earn. I'm not talking about a hobby or something vague. I'm talking about a specific skill or credential that makes you more valuable and harder to replace. Here's what actually worked for me. When I started my consulting career, I started stacking professional certifications, and I mean the legitimate ones, the kind of credentials that hiring managers and clients actually recognize and that directly justify a higher rate or a better title. I'm not talking about a random online certificate that you can print off in 20 minutes. I'm talking real certifications that actually take real effort and carry real weight in the industry. Each certification I added either opened up a new door, gave me leverage in a salary conversation, or made me the obvious choice on a project over someone without it. When you're in consulting, especially, your certifications are essentially your bargaining chips. The more you have, the more money and projects you can command, to an extent. So, to give you an example, a $500 to $1,000 certification that gets you a $10,000 raise pays for itself in the first month. Run that raise forward 10 years, and that single investment is worth 6 figures in additional income. So I would figure out what the recognized certifications are in your specific field. You can easily do this by looking at job descriptions or stalking on people's LinkedIn profiles. Invest in the ones that translate directly into income, and I would do it before you actually need them. Next, 2000 or 20% of the money goes into a proper emergency fund. By your late 20s, your financial life has more moving parts than it did at 22. You got a car payment, rent, student loans, maybe a family. If something goes wrong and you don't have a cushion, you're either putting it on a credit card or pulling from your investments at the worst possible time. That's how people lock in losses and set themselves back a year or two in one bad month. I would shoot for 3 to 6 months of living expenses in a high yield savings account, not a regular checking account. Please don't do that. That money should at least be working while it sits there. $2,000 doesn't sound much, but I would look at it like a floor and not a ceiling. Just start there and build it up slowly over time. Without this bucket, everything else is going to feel way more fragile. For the next bucket, this is the biggest single allocation, 3,500 or 35% into a simple index fund or an ETF. I say this because let me take you back to the first real stock I ever bought, because this will tell you everything you need to know about where I started. Right after landing my first real job, I took a large portion of my hard earned money and threw it into Fannie Mae, an OTC stock. If you don't know what that means, OTC or over the counter is basically the wild west of investing and trading. These stocks aren't listed on the major exchanges like the NASDAQ or New York Stock Exchange. The spreads between buying and selling prices are wide, price swings are very violent, and you have pump and dump schemes everywhere. I knew none of that at the time. A close friend of mine just mentioned it to me, and I saw it as a cheap stock with upside potential. So I jumped in. And what's funny is within days, I watched my investment nearly double. I genuinely thought I had figured something out, like I had some kind of instinct for this. So I held, because why sell when you can get more, right? Well, sadly, after about 3 to 4 days, the stock peaked and then I watched it bleed slowly, day after day, until most of it was just gone. That experience taught me some expensive lessons. I let greed and ego make my decisions. And the market doesn't care about either of those things. On top of that, I had zero understanding of technical analysis. I didn't know what a moving average was, couldn't read a chart properly, had no idea how to time an entry or exit. Buying a stock without technicals for me now is like driving with your eyes closed. These days, I rely heavily on several different indicators that I've spent years backtesting to know exactly when to get in and when to get out. Now, keep in mind, at this time, I was in my early 20s. At this age, people overcomplicate this. They want to find the next big thing, time the market, pick individual winners. Sometimes it does work short term, which kind of makes it worse because then they start to think that they figure something out. The boring path, like with the index funds or ETFs and consistent contributions without touching it too much, is actually what builds wealth for most people. The caveat is it takes a much longer time for it to play out. But honestly, the normal boring route can, well, get really boring, which is still okay, and I keep that as your core position you barely touch. But if you want a little excitement, this next bucket is where we get into the asymmetric high conviction bets. So I throw 2,500 or 25% into a concentrated position you actually understand and believe in. For me, that's still technology and Bitcoin. Now, this isn't financial advice, but if you've been watching the market lately, you've seen major tech names get absolutely hammered. And I still think there's more pain coming later this year. But here's the thing, when a company with real fundamentals sells off because of macro fear or interest rate pressure, the business really hasn't changed, but the share price just got cheaper. Right now, I think there are some real interesting names in the AI space that, yes, carries more risk, but also more upside than your typical blue chip stock. Take Palantir, for example. Palantir is quietly becoming the data infrastructure backbone for both government and enterprise AI. Is it higher volatility? Yes, but that volatility cuts both ways. Then there's Tesla. Love it or hate it, Tesla is no longer just a car company. It's an energy company, a robotics company, and depending on who you ask, even an AI company. The FSD and Optimus plays are either going to look genius or completely delusional in the next 5 years. That uncertainty is exactly why the risk versus reward is so interesting right now. And then there's Anthropic. It's not publicly traded yet, but I would keep it on your radar. I don't generally mess with IPOs much, but when it eventually comes, I think it'll be one of the most watched listings in years. You can also go broader with something like the QQQ, which tracks the NASDAQ 100 and gives you a more diversified tech exposure without having to pick individual stocks. It is lower risk than the individual bets, but you still capture the upside of the sector moving. And some of the best entry points in history looked terrifying while they were happening. There was a time when Amazon dropped over 90% during the dot-com crash. And the people who bought into that fear with real conviction, they changed their financial lives forever. Now, I'm not saying go all in on one name, but I think 2,500 or 35% of the 10K spread across two or three high quality tech positions you actually understand is a reasonable bet with some serious upside over the next 3 to 5 years. Now, if you've been curious about Bitcoin but want nothing to do with crypto wallets, seed phrases, or exchanges, IBIT or IBIT is the simpler option. It's the iShares Bitcoin Trust from BlackRock, and it trades on the stock exchange like any other normal ticker. You buy it through your regular brokerage account, and BlackRock holds the actual Bitcoin on your behalf. The reason this matters isn't just convenience, it's who's behind it. BlackRock manages something like over 10 trillion in assets, and they're not going anywhere anytime soon. Most of my wealth came from Bitcoin and leveraged Bitcoin bets, specifically in MicroStrategy. That's what gave me the option to walk away from my corporate job and eventually move to Taiwan. Now, I'm not saying that's everyone's outcome. I'm saying this can actually happen despite it sounding gimmicky, and I've lived through it firsthand. Whatever you end up deciding, The point is to take a real position in something you understand. With money you can be patient with, and more importantly, lose it all and not be affected by it if you're wrong. For the last bucket of $1,000, I spend it however you want. You still need to give yourself a break and have some fun in your life. The mistake I made in my 20s was I didn't have enough control over how much I spent on my wants, which was cars. It was a huge money pit for me. So I would stick with 10% as best as I can. Now, I'm not saying it needs to be 10% forever. Once you start making more money, you can gradually raise that up. If you're not at $10,000 yet, the percentages work at any number. Start with what you have. The biggest financial mistake I see people in their 20s make isn't a bad investment. It's waiting. Waiting for more money, more clarity, better timing. Meanwhile, the clock is running. I would start with what you have, make intentional decisions, and then take action. And you can adjust as you go. That's it. Anyways, that's it for today's video. Thank you so much for watching. If you made it this far, make sure to hit the like, drop a comment, subscribe if you found this useful, and I'll see you guys in the next one. Peace.